Hello friends, how are you doing out there? I hope you're enjoying these videos and I'm able to help you navigate through the markets better. Friends, frankly, last week when I made that thumbnail about whether the Nifty will go to 16,000 levels or not, I was in a quandary. Like I shared in the video with you, the systems were unclear as to whether the Nifty would climb Mount 16,000, even though the Nifty had closed not even 200 points below that 16,000 mark on that Friday. But I decided that I would stick to facts. I decided I would stick to the truth rather than give you an unpleasant lie which you are seeing in the picture. I would stick to the truth even if it meant fewer views onto my video. So that is the tradition that we follow, and that is the tradition I am going to follow in this video as well. Now, let's take a look at what happened to the market in the week gone by. Now, as you can see on the market roundup, it shows that the Nifty kind of outperformed the Bank Nifty, relatively speaking. Outperformed is a slightly confusing term for some of you because both the indices have fallen. It's just that the Bank Nifty has fallen more than the Nifty 50, which is why the Nifty outperformed the Bank Nifty. It fell less. Now, the reasons for this fall are something that my veteran viewers who've been watching my videos for a while now already know. Inflation, the US dollar index, 10-year benchmark bond yields, rising oil and gas prices, and we're going to get to these things in a bit now. Now, as per the market roundup window, you see bullion also rose in a bout of pullback buying in spite of the fact that the dollar was stronger. A strong dollar normally makes commodity prices go lower. So oil and gas rose, which is inflationary because these are what I call multiplier commodities. When oil and gas prices go up, everything from fruits, vegetables, milk, eggs, etc., everything goes up, which is not really very great. Now, the USD INR crossed a psychological round number of 75 on an intraday basis on Friday, but it closed lower. For those who are watching my videos long enough, you are aware of what I call imported inflation. Everything that we import from abroad, your mobile phones, your computers, televisions, cars, etc., imported parts or the royalty that we pay on technology transferred for these cars, makes the production of these things expensive here. And imported oil and gas, and these, remember I told you, are multiplier commodities. They make inflation go up. Now, the US dollar rising is triggering the fears of, into inverted commas, imported inflation. Now, the 10-year benchmark bond yield, which rose, is another concern. We are going to get that going and discuss in greater detail in the bond segment. Now, coming up on your screen is the MWPL chart. Now, the retail segment continues to party with their ever-rising long positions. Now, besides, MWPL also tends to go up after expiry, and it keeps rising till the third week of a derivative cycle. Now, watch the indices and stock futures turnover on your screen. Do note that these are cumulative figures of 3 months, which means July, August and September. And what they are showing is that stock futures turnover is clinging to a period low. This is a 20-day period chart, and what you are seeing is almost a 20-day low of stock futures turnover. And the index futures turnover is also fairly pathetic. I think this raises the impact cost of trading for average trader. The bid and offer spreads, the difference between buying and selling prices, simply expands, and when push comes to shove, for example, when the market starts to fall, you will be able to get entries, but getting exits will become more of a challenge because the bid and offer spreads will widen. And you might even have to sacrifice some of your profits to exit a trade. even have to incur a loss to exit a trade because turnover goes down and bid and offer spreads widen. Just check out the snapquote window on your screen. This is just a hypothetical snapquote window I'm sharing with you. Nothing to do with that particular counter, and don't need to buy or sell anything of that company's share. What you are seeing here is a very wide difference between the bid and offer spread. Remember, the minimum difference is 1 tick, which is 5 paise. See how wide the difference has become? Now, this is because the turnover has fallen on this counter. If the overall market turnover continues to decline like this, the bid and offer spreads widen, your entry will be possible, which is ingress. Your exit, which is known as egress, will become extremely challenging. This is something that you need to be aware of as a trader. Now, check out the basis chart. And both indices are showing basis contraction, which means the futures premium is narrowing down compared to the spot. This is partly due to selling at higher levels, and this erosion in the futures premium also affects option premiums, because option sellers would immediately identify with what I'm saying. As the market values market values fall, the Nifty and the Bank Nifty values fall, your call option premiums are eroding rapidly. There is also another factor of that time decay. As we progress into the derivative series, the premium routinely tends to fall. That is normal. Now watch this development of the basis, which is the futures premium versus the spot, daily on my social media accounts. Every evening I update these data in a very graphical format, very easy to understand. My contact coordinates of the social media accounts will come up on your screen at the end of this video. So do make it a point to connect with me there. Let's now move to the impetus chart, which is an exclusive in-house study which you won't find elsewhere in the public domain. This shows that the Nifty and Bank Nifty in a continued state of decline. Last week I had warned you that the slight uptick, though it was welcome, it was not enough to revive the Bank Nifty and the Nifty 50. And the Bank Nifty is appearing under severe pressure as bullish velocity is missing as per this statistical study. Now, unless there is a substantial pickup in the near term, the market will be under pressure. So I want the impetus to rise along with prices immediately. Otherwise, I think the bulls are likely to surrender much of their newfound strength. Here again, this is a very critical area of interest for system-based traders. If you are following statistical data or system-based trades, do watch this study very carefully. Now, let's come to the most popular metric amongst those that we've started sharing with our friends recently. Let's take a look at what the FIIs are doing. They've raised their shorts on stock futures to basically period lows, and they've cut their index longs to 57,574 lots from 79,486 lots. That means they've basically cut their index longs, and this tells you that the FIIs seem to be less than gung-ho on the markets here. Let's take a look at what the DIIs are doing, the domestic investment institutions. They may be buyers in the cash segment, but they are very aggressive sellers in the F&O space. As a matter of fact, their shorts in both the indices and stock futures are at a period high, as you can see in this 20-day chart. The domestic investment institutions are clearly skewed in their view, at least in the F&O space. They are bearish. The prop traders, and these are smart cookies, they are brokers and they're specialists who are trading on their own account, and they are clued on as to who's buying and who's selling. Now, this segment of the market has raised their index longs to 7,715 lots from the previous week, where it was 2,167 lots. Not much, but they've increased mildly. Their stock longs have gone up too, as a matter of fact. Now, on Friday, they ended at 1,83,755 lots from the previous Friday at 1,43,455 lots. But this figure is not really substantial enough. Now, the retail segment. Now, this is nothing short of a revelation. Their stock futures longs have crossed 1 million lot mark, as my thumbnail mentions before this video. Now, they've closed the week at 10,01,278 lots from the previous weekend of 9,56,984 lots. That's big. But that's not the only point I'm trying to make. Take a look at the DII chart again. The DIIs have a net short position in stock futures of 11,42,868 lots, and their index shorts are 55,889 lots, which means two things are happening. Number one, retail traders are single-handedly pushing the prices higher with their F&O long exposure, and secondly, they are taking a head-on collision with the domestic investment institutions, the DIIs. This is historical by any means. This fight will be a jaw-dropping one and something that you're going to have to monitor absolutely clearly and keenly. My friends, let's now go to the 10-year benchmark bond yields. I feel so vindicated. I feel a sense of satisfaction in my insistence that people who don't understand bond markets cannot succeed big time in even stock markets. You might get mediocre success, but if you want big time success, you must understand the bond markets, because the bond markets are the source of all finance. On your screen is an article of Economic Times, which is carrying a full scale article, and they are mentioning how bond prices are hurting the banks by way of mark to market on their bond portfolio in their balance sheets. Note that we are nearing the quarterly results time of banks and how this article has been timed therefore. I have been warning my viewers since many quarters not to ignore the bond markets no matter what anyone tells you. At the risk of sounding arrogant, I'll tell you just this. Anybody who tells you to ignore the bond market is just plain wrong. Alright? They're just plain wrong. This market is very simply the source of all money, and if you don't know where the source of money is headed towards, inflow or outflow, you're basically clueless as to what's happening. Now, rising yields may be coming across as somewhat of a possibility. The bond yields are also a warning of inflation, tightness in money markets, and possible that the RBI may just give some kind of forward guidance. They may not raise, the Monetary Policy Committee meeting may not really raise the rates in August, but they might just give a forward guidance about being a little more hawkish than they have been so far. Now on your screen, note how the 10-year benchmark bond yield has risen to 6.06%. Also remember how the Government Securities Acquisition Program, the GSAP, recently conducted failed to keep the coupon rates below 6% sustainably, which told you that the market simply doesn't buy the lower yield hypothesis. Also note how the US dollar has briefly crossed the 75 mark but closed lower. Now everything imported, cell phones, computers, cars, fuel, etc. will bring in imported inflation. Now check out this graphic as the government announces limits even on stocks of edible items. This is something that I've been warning you about, inflation. I've been telling you that milk, meat, eggs, grains, pulses, etc. everything is about to get expensive. Many of you may not have liked this kind of view that I hold, and some of you have even sent me messages on my social media account, communicated with me on WhatsApp. Hey, I'm not here to tell you pleasant lies. I'm here to tell you unpleasant truths. So the government is now enforcing stocking limits on food items so as to bring down food price inflation. That tells you that there is some serious moves afoot. It is getting serious now. Now, for the banking stocks to rise sustainably, bond yields must stop rising. That's SOS, but preferably they must start falling. Now, watch this space very, very keenly every day. Your trades on the Bank Nifty and banking stocks will depend on the benchmark bond yields. Friends, let's now move to the US dollar index, the DIIs. Now, this US currency benchmark shows a rising trend as higher bottoms and higher tops on the daily chart shows on screen. The price remains above its 25-day exponential moving average, which means the short-term outlook also remains positive. Now, this index rising is negative for emerging markets, including India, because we are import dependent and a rising dollar brings in inflation. The index rose on 4 out of 5 sessions last week, and the bullish bias was clearly evident. Now let's check out the weekly chart. The bullish candle engulfs the body of the previous bearish candle, which is called a Tsutsumi formation in Japanese candlesticks parlance. Now this shows that the bulls overpowered the bears and pushed prices towards the previous high, which is near the 93.5 levels. Now remember, this is a level I've been talking about since a couple of weeks. The price stays above its 25-week exponential moving average, which makes the medium-term outlook also as bullish. Last week, I advocated a range between 92.95 on the upside and 90.75 on the downside, which held perfectly well. The coming week is likely to witness an estimated, I repeat the word estimated, a range between 93.30 on the upside and 91.15 on the downside. Now watch the dollar keenly, because everything from oil, gold, equities and bond yields will depend on this. Friends, let's now go to the Bank Nifty, which fell on 4 out of 5 trading sessions, as you can see on your daily chart on your screen. Friday was an exception because of short covering ahead of the weekend, which gave some breathing space to the bulls. Note how this index is unable to overcome even the recent June peaks. Forget about the all-time high in February. The price is precariously poised at its 25-day exponential moving average, which makes the index's outlook tentative at best. We need to see a breakout or a breakdown beyond either significant high or significant low before a bigger directional move can occur. The impetus chart, which I showed you earlier, made it very clear that the bulls, the bulls lack the determination and the momentum for now. They need to pull up their socks and get cracking as soon as possible. Now let's move to the weekly chart, where the red candle has pierced the previous green candle. Think of this as somebody shoving a knife into somebody else's body. Though you may not necessarily be dead, but the person who's been wounded is definitely grievously hurt. So it is of paramount importance that the Bank Nifty stay above the 35,500 mark so that the bulls can revive the sentiments again. Unless that happens, I believe the Bank Nifty is likely to be under pressure. The weekly chart shows the price remaining above its 25-week exponential moving average, which means the medium-term outlook is positive. And in the week gone by, the index was number 4 on the most volatile list. But last week, it climbed by 1 notch to number 3, because volatility actually rose last week. And I had advocated a range between 36,950 on the upside and 33,775 on the downside, which held in spite of all the volatility. And the coming week is likely to see an estimated, I repeat the word estimated, range between 36,325 on the upside and 33,300 on the downside. I would suggest you stay light on exposure levels on all your trades. Friends, let's now go to the Nifty 50, which fell on 4 out of 5 trading sessions last week. And the daily chart shows that this index too is precariously poised on its 25-day exponential moving average, which makes the bulls tentative for now. Now, the impetus chart had confirmed that the bulls were lacking momentum, lacking strength even earlier, as we saw in the impetus chart. Here again, we need a breakout in either direction beyond the previous peak or the recent lows before a directional trade can be taken. Note how this index is fairly close to its all-time high, which relatively speaking, as compared to the Bank Nifty, it makes it a better potential candidate for a breakout earlier as compared to the Bank Nifty. Now, let's come back, let's go forward to the weekly chart on screen, where the price has pierced into the previous week's bullish candle, but it's not pierced deep enough like the Bank Nifty. Therefore, the bulls are not yet completely jeopardized as the Bank Nifty bulls are. The price remains above its 25-week exponential moving average, which means even the medium-term outlook remains positive for now. In the week prior to last, the index was number 19 on the most volatile list, but it fell 3 notches to number 22 because the ranges contracted intraday. Last week, I advocated a range between 16,325 on the upside and 15,375 on the downside, which held perfectly. The coming week is likely to see an estimated, I repeat the word estimated, range between 16,175 on the upside and 15,250 on the downside. I would suggest, my friends, you keep trading on small exposure footprint because the markets seem jittery. And the Jensen's measure has become a little hostile over the previous week for fresh aggressive longs. So all new trades must be on curtailed exposure, and you must follow your stop losses extremely diligently. Now, friends, the indices done, I come to the most popular segment of the market, where I recommend 5 high beta, high impetus stocks where you take small exposure, wait for large price moves, and 5 low beta, low impetus stocks where you take big exposure, wait for small price moves. Now, high beta stocks is led by Deepak Nitrite at number 1, Naukri.com number 2, number 3 is Aditya Birla Fashion Retail, number 4 Indraprastha Gas, number 5 IDFC First Bank. Now, low beta, low impetus stock list is led by LIC Housing at number 1, number 2 Mahindra & Mahindra Finance, number 3 Amar Raja Batteries, number 4 Coal India, and number 5 Adani Ports. Friends, do note that volatility changes from day to day, and therefore this hierarchy, this list is extremely dynamic. It will change on a day-to-day basis. Friends, if you liked this video, I would appreciate it if you subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here. In the comments section, do keep the lines of communication open. Let me know what you think of this video. And in the description below this video is a hyperlink to Equity Masters YouTube channel, wherein I put in 4 videos every week and share my thoughts with my viewers there. Do subscribe to that YouTube channel. And also is a hyperlink to download a free trading guide from Equity Master. Do avail of this offer too, my friends. I bid goodbye to you, not before wishing you a very, very profitable week ahead, my friends. Do take very good care of your health, your trades, your investments, friends and families. And thank you for your patience and watching my video. Till we meet again in my next. Take care. Bye-bye.